The freight market keeps brokers on their toes, and 2025 is no exception. This is SPI Logistics, and in this video, we're unpacking the latest rate trends, capacity patterns, and seasonal shifts shaping the industry right now. Freight brokerage in 2025 is defined by uncertainty. Margins are thinner, competition is fierce, and the balance between shipper demand and carrier capacity keeps shifting. To stay profitable, brokers need to understand not just what the numbers say, but why the market is moving the way it is. Let's break down the three major trends driving today's freight environment. First, let's talk about rate pressure. Spot rates are still sitting below contract rates, and that gap is squeezing broker margins across the board. Shippers are holding the upper hand in pricing negotiations, while smaller brokerages are finding it harder to maintain profitability. To adapt, brokers are leveraging real-time rate data to quote smarter and protect margins, targeting short-term or regional contracts where flexibility can offset lower national rates, focusing on niche freight that offers higher premiums and less rate volatility. This market inversion won't last forever, but right now, precision pricing and adaptability are key. The next big trend? Capacity oversupply. Nationally, the market is still heavy with trucks, giving shippers leverage, but that's not the full story. Certain regions and sectors are tightening fast, especially import-driven lanes and coastal hubs where volumes are rising, refrigerated and temperature-controlled freight, which is peaking ahead of holiday demand, industrial lanes tied to steel, solar, and infrastructure projects, where sustained demand is pushing rates higher. Smart brokers are adapting regionally, tracking where supply is tightening and shifting their carrier relationships accordingly. Finally, let's talk about seasonality and volatility. While the market may appear relatively steady in some lanes, that doesn't mean brokers can relax. Seasonal demand spikes are tightening reefer and dry van capacity in key corridors. Backhaul repositioning costs are rising, creating margin pressure on return lanes. And muted consumer demand in some areas means brokers need to stay agile, adjusting lane coverage as the market ebbs and flows. The brokers who win are the ones who can read these shifts in real time and respond faster than their competitors. Here's what it all means. Rate compression and excess capacity are reshaping the brokerage model. Transactional freight alone won't cut it anymore. Brokers need to build trust, niche expertise, and carrier loyalty to keep their margins healthy. Even in a tough market, opportunity is everywhere. Those who use data analytics, market forecasting tools, and strategic carrier partnerships are turning volatility into advantage. The key isn't predicting the market perfectly, it's being ready to pivot when it changes. Market shifts are part of the freight game, but smart brokers don't wait for stability. They build strategies that thrive in uncertainty. Don't forget to subscribe for more educational breakdowns on freight markets, operations, and brokerage growth.